The chart types. Some of the chart types are line chart, bar chart and candlestick chart. The line chart and the bar chart. At first I'll just try to tell you the theory part, and later I'll be showing you the bar chart, line chart, candlestick chart on charts, real charts. Okay, so at first just try to understand the theory part. The line chart is the most basic chart type and it uses only one data point to form the chart. When it comes to technical analysis, a line chart is formed by plotting the closing prices of a stock or an index. A dot is placed for each closing price and the various dots are then connected by a line. So line chart is a typical chart like this. You'll just get to see a line. I'll show you. The line chart can be plotted for various time frames, namely monthly, weekly, hourly, etc. So if you wish to draw a weekly line chart, you can use weekly closing prices of securities and likewise for the other time frames as well. The advantage of the line chart is its simplicity. With one glance, the trader can identify the general trend of a security. However, the disadvantage of the line chart is also its simplicity. Simplicity is both the advantage and the disadvantage of the line chart. Besides giving the analyst a view on the trend, the line chart does not provide any additional detail. Plus, the line chart takes into consideration only the closing price, ignoring the open, high and low. For this reason, traders prefer not to use the line charts, because I'll be discussing later why open, high, low prices are also equally important. So as the line chart does not discuss about the open, high and low prices or doesn't take into consideration, it only considers the closing price. So traders generally avoid line charts. The bar chart on the other hand is a bit more versatile. Bar chart displays all the four prices variably, namely open, high, low and close. Bar chart shows you all the four components. A bar chart has three components. The central line. The top of the bar indicates the highest price the security has reached. The bottom end of the bar indicates the lowest price for the same period. The left mark indicates the open and the right mark indicates the close. Let me show you a bar now. Bar and the line chart. This is a typical bar chart. Okay. This is a green bar and this is a red bar. That means this is a bullish bar and this is a bearish bar. So this particular point is the lowest price of the stock and this particular point is was the highest price the stock or the security has reached. On the left hand side, the left small bar indicates, the left small bar will always indicate the open price and the right bar will indicate the closing price. If the closing price is above this open price, then it is a bullish sign, or the means that the price has gone up. Let me show you an example or give you an example. Suppose it opened at 99. Okay, 99 and it made a low of, let's say, 97.5 and it made a high of 102 and given us a closing of 101. So the open price is smaller or lower than the closing price, or the closing price is greater than the open price. As a result, the price has gone up, which means the price has gone up. So it is a bullish sign, or it's a bullish bar. On the other hand, see, open price is greater than the closing price, so the price has gone down, which means that it's a bearish sign. This highest point shows us the highest price of the security. The lowest point shows us the lowest point of the security. The right hand side will always show you the closing price and the left hand side will always show you the opening price. For example, it opened at 100, made a high of 101, made a low of say 96, and ultimately closed at 97, and it opened at 100. So there's a difference of 3 minus 3. It opened at 100 and it closed at 97. So open price is greater than the closing price, so which means that the price went down, so it's a bearish bar. Let me show you in chart. See, this is a typical bar chart. These are all bars. These look pretty confusing. We'll be mainly focusing on candlestick chart. Let me show you now the line chart I was talking about. This is a typical line chart. See, they are very simple in comparison to the bar chart, but as I said, the simplicity is their advantage and also the disadvantage, because they do not consider the open, high and low. They just consider the closing price. So let's get back to the presentation. The length of the central line indicates the range for the day. A range can be defined as the three difference between the high and low. Longer the line, bigger the range. Shorter the line, smaller is the range. It's talking about the bar. While the bar chart displays all the 4 data points, it still lacks a visual appeal. See, I was talking about this. It lacks visual appeal and it looks pretty confusing also. This is probably the biggest disadvantage of a bar chart. It becomes really hard to spot potential patterns brewing. When one is looking at a bar chart, the complexity increases when a trader has to analyze multiple charts during the day. Hence, for this reason, traders do not use bar charts, because they are also pretty confusing and not easily spottable. As a result, traders avoid bar charts. Now let's understand the history of the Japanese candlestick in few seconds. Before we jump in, it is worth spending time to understand the history of the Japanese candlestick. As the name suggests, the candlestick originated from Japan. The earliest use of candlestick dates back to the 18th century by a Japanese rice merchant named Homa Munehisa. Though the candlesticks have been in existence for a long time in Japan and are probably the oldest form of price analysis, the Western world traders were clueless about it. It is believed that sometime around 1980s, a trader named Steve Nissen accidentally discovered candlesticks, and he introduced the methodology to the rest of the world. He authored the first ever book on candlestick titled Japanese Candlestick Charting Techniques, which is still a favorite amongst many traders. Most of the pattern in candlestick still remains the Japanese names, thus giving an oriental feel to technical analysis. Now let's understand the anatomy of candlestick. So let me take you to the charts. So this is a typical candlestick that we see on the screen. The green candle signifies a bullish candle and the red or orange candle signifies a bearish candle. See, this is the open price, this is the candlestick, okay. This is the open price. If you see a green candle in front of you, so this point will be the open price, and the wick that you see on the screen, the lower wick will show you the lowest price that the stock has reached, and the upper wick will show you the highest price the stock has reached, and this is the closing price. This is the open price, this is the close price, this is the high and the low. This is the body. Hopefully you have understood. This is the highest price the stock has reached. This is the low price or the lowest price the stock has reached. This will always be the opening price, and this will always be the closing price. If you see a red or an orange candle on the screen, which is a sign of bearishness, then open price will go up. Means, if suppose this is a bearish candle and this is a bearish candle, no need to imply this is a bearish candle, so the color is red. This is the open price, this is the close price, this is the low price, this is the high price. Let me give an example. This is, suppose the stock opened at 99, it made a low of 98. Sorry, it made a it made a high of 100. It made a low of 95, and ultimately it closed at 97. So the open price is greater than the closing price. So this is a bearish sign. The open price is greater than the closing price, which means that it is a bearish candle, and a bearish candle is shown like this: opened here, made a high here, made a low here, and ultimately closed here. Similarly, just look at the left side. It opened at 99, made a low of 98, and it made a high of, let's say, 102, and ultimately closed at 101. Open price is greater than the closing, the closing price is greater than the opening price, which means that the stock is bullish. As a result, we get to see a green candle. So traders mainly use candlestick around the world because they are easy to understand, and they also tell us the psychology of the market. Suppose you see a green candle on the screen, obviously you'll understand that okay, the market is bullish, or traders are mainly onto buying side. If you see a red candle on the screen, then you'll understand that traders are mainly on the selling side. They tell us the psychology of the market. As a result, traders prefer to use candlestick in comparison to the bar chart and the line chart. Let me show you on chart. Now we'll just remove this bar chart and select candlestick. This is a typical candlestick chart. Let's consider this example. This is a red candle. So it opened here, made a high here, and made a low here, and ultimately closed here. Red candle means bullish, bearish sign. Just look at the other candle. Again, opened here, made a high here, or see, it opened at 11095, made a high of 11,105, made a low of 11,068, and ultimately closed at 11,073. So the open price is greater than the closing price, which means that it is a sign of bearishness, or the sellers are in pressure, or the sellers are dominating the market. So this is how we use or understand candlestick. In the later lessons or classes, I will tell you in detail how to use candlestick, how to understand the psychology of the candlestick, how to understand the candlestick patterns and all. So as of now, that's it for this class or lesson. Thank you so much.